The pattern from 1929 is repeating. Why 2026 looks like the Great Depression. On October 17th, 2026, rain hits a window like thrown gravel, and a trading floor glows like a crime scene. We think crashes happen from panic. They don't. They happen when the ledger shows insolvency, and the balance sheet whispers bankruptcy. A century earlier, on September 5th, 1929, a famous economist promised a high plateau to a room full of believers. The room wanted prophecy, not math. 9 trading days later, the market began bleeding, and the ink on America's balance sheet turned dark. History loves costumes, so it dresses collapse in headlines and speeches and heroic excuses. But the true director sits in the back office. It's the accountant with the aging spreadsheet. It's the creditor counting interest. It's the cold arithmetic of cash. In the late 1920s, America looked like a polished brass band marching through sunlight. New cars hummed on new roads, and radios stitched voices into kitchens. The stock tapes sang, and everyone believed the future had finally been paid for. Money had a smell then, like fresh paper and cigar smoke and warm steel. Parades moved under flags, and cities climbed upward with scaffolds like ribs. It felt like majesty. It felt permanent. But beneath the surface the foundation was rotting, and it rotted in neat columns. The rot was leverage, hidden behind confident smiles. Debt didn't look like a monster yet. It looked like opportunity. Back then, you could buy a share with 10 cents on the dollar, like renting riches by the hour. Put down $100 and control $1,000 of stock. If the price rose 10%, you doubled. If it fell 10%, you were erased. By early September of 1929, the Dow sat near 381, and the nation's ego sat higher. Margin debt was whispered around $8.5 billion, a number that sounded abstract until it wasn't. Think about the scale of that. It was a mortgage on optimism. Everyone had a story for why the old rules were dead. Automobiles, electricity, and radios were the new religion. The sermon said cycles were finished. The ledger disagreed, quietly, patiently, like a detective taking notes. The antagonist wasn't a villain with a gun. It was a bondholder with a pen. It was a broker issuing margin calls at dawn. It was the market itself, a faceless creditor that never sleeps. In 1929, the trap was addiction, and it was a clean addiction. Borrow a little. Win a lot. Borrow more. The habit grew until the body couldn't live without it. The first symptom wasn't a scream. It was a small tremor in the real economy. Steel production soft, shipments slowed, and inventories sat like unsold bread. But prices kept rising anyway, because the crowd mistook momentum for gravity. Then October 24th arrived, and selling began like a cough in a packed theater. Margin calls went out in batches, cold and procedural. Forced selling met thin buying, and the market discovered it had no floor. It had only confidence. The rule of 3 hit like a blunt object. The gold was doubted. The credit was frozen. The buyers had vanished. And the proud new era turned into a liquidation sale. What followed wasn't just a crash. It was a long strangling. From 1929 into 1932, the Dow slid toward 41, and the decline felt personal, like betrayal written in numbers. Wealth didn't explode once. It leaked out for years. Banks failed because their assets were dreams and their liabilities were real. Roughly 9,000 banks went under in that era, a graveyard of storefronts and locked doors. Depositors learned the first law of finance. Your money isn't yours when the bank is insolvent. Unemployment didn't rise politely. It surged toward 25%, a quarter of workers left staring at closed gates. Homes were lost, farms were seized, and hunger arrived with receipts. Poverty wasn't a moral lesson. It was a cash shortage. Now pull your eyes back to the present, because the same handwriting is on today's paperwork. In 2025, the streets look different, but the ledgers rhyme. Screens replaced ticker tape, and apps replaced brokers, but leverage kept its teeth. The new majesty is digital and bright and loud. Artificial intelligence is sold like electricity was sold, like destiny in a box. Mega-cap stocks march in a parade of green candles. People call it progress, and progress becomes an excuse. There's a particular sound to bubbles if you listen closely. It's the sound of risk being mocked. It's the sound of caution being called stupidity. It's the sound of someone saying this time is different, like a magic spell. The modern trap isn't just margin loans listed on a statement. It's leverage hiding in options, leverage ETFs, and quiet credit lines against portfolios. It's crypto exchanges offering 25x, 50x, even 100x bets. Leverage doesn't care what outfit it wears. In one ledger, you might see margin debt around $800 billion, and someone will tell you it's manageable. But in another ledger, you'll see synthetic exposure stacked like unstable bricks. Options volume rolling weekly turns small accounts into powder kegs. Let that number sink in. The everything bubble is the modern signature because greed got diversified. Stocks stretch valuations like rubber. Housing prices float above incomes like balloons with thin strings. Crypto swells on narrative, not cash flow, and private markets mark their own homework. Concentration adds another fuse. Imagine 7 giants holding a third of an index's weight, like a bridge supported by too few cables. If those cables snap, the whole structure tilts. It's not fear, it's mechanics. The delayed crash psychology returns because humans love comfortable lies. Every dip gets bought, like a reflex. Every warning gets laughed at, like superstition. People don't prepare for collapse in a boom. They prepare excuses. In late 1929, officials said business was sound, and it sounded soothing on the radio. In 2025, the modern version is a post, a clip, a confident thread. The Fed has it handled, they say. Liquidity will save us, they say. But liquidity is not solvency, and that's the line everyone forgets. Liquidity is a glass of water. Solvency is whether you can breathe underwater. When the balance sheet is broken, water is just decoration. So where is the monster now? It lives in refinancing calendars. It lives in short-term debt that must roll every few months. It lives in the corporate bond market, where investment grade can become junk in a single downgrade. In this story, the antagonist isn't a president or a war. It's the credit committee. It's the bond auction. It's the silent crowd of lenders demanding higher yields. They don't hate you. They just want their money back. Picture a company with $40 billion of debt, paying 3% when money was cheap. Now picture that same company refinancing at 7% after a brutal inflation scare. Interest expense doubles like a snapped bone. Suddenly layoffs aren't strategy, they're triage. And households aren't clean either, not anymore. Credit card balances climb past $1.2 trillion in this timeline, and delinquencies creep like mold. Auto loans stretch to 84 months, and repossessions rise. The consumer becomes a balance sheet, too. Now imagine a spark, because collapses always get a spark. It might be a regional bank announcing a temporary liquidity issue that isn't temporary. It might be a sovereign bond auction failing by $30 billion. It might be an energy shock pushing inflation back above 6%. The spark doesn't need to be huge. The system is the problem, not the headline. When leverage is high, any shove becomes a fall. That's why predicting the spark is a trap. In 1929, the first wave felt survivable to the untrained eye. People called it a healthy correction. In our 2026 mirror, the first leg down might be 18%, then 26%, then 33%. Each drop gets bought until the buyers run out of cash. Then comes the margin call, the cleanest violence finance can commit. Your broker doesn't negotiate with your feelings. Your collateral fails a rule, and the account gets liquidated. It's foreclosure, but faster, and it happens on a Tuesday morning. Now we enter the spiral because collapses are chronological, not theatrical. First, equities slide and volatility spikes above 55 on a fear gauge nobody admits watching. Next, credit spreads widen by 250 basis points, and refinancing doors slam. Then layoffs begin, and the economy catches fire. The rule of three returns, because tragedy loves rhythm. The credit was priced wrong. The risk was hidden. The cash was gone. And suddenly the strong-looking empire discovers it was standing on short-term loans. At this point, officials reach for the oldest script in government. They announce facilities, backstops, emergency programs with reassuring acronyms. It slows the panic for a week. But it doesn't change the underlying ledger. Insolvency doesn't fear speeches. Here's where the bull trap is born, the deadliest phase in any collapse. In this timeline, markets rebound 14% in 6 weeks, and commentators declare the bottom. Retail returns, proud and eager, buying because pain taught them nothing. Then the next leg down arrives. The grinding decline is the part nobody can mean into bravery. It's month after month of lower highs, like a heartbeat weakening. It's 2027 turning into 2028 with a slow drain of hope. It's a recession that doesn't end when you want it to. Jobs vanish first in places that looked safest. Tech trims 12%, then 18%, then freezes hiring completely. Construction slows as mortgages sit above 8.5%. Retail closes stores in chains, like lights shutting off down a hallway. Housing, the great national idol, begins to break in slow motion. Prices fall 9%, then 17%, then 26% in overheated pockets. Negative equity returns like a ghost. People don't walk away because they're lazy. They walk away because math locks the door. Now watch the banks, because banks are mirrors. Their assets are long-term loans, and their liabilities are short-term confidence. When confidence gets scared, it runs. A bank run isn't chaos. It's a rational response to insolvency. In 1929, depositors lined up outside brick buildings with paper passbooks in hand. In 2026, the line is invisible, 1,000 phones refreshing balances at once. Funds move in seconds, and the bank's balance sheet collapses faster than a rumor spreads. This is how a financial thriller becomes social reality. Credit disappears and small businesses can't make payroll. Landlords can't refinance, and they raise rent until tenants break. Food banks swell, not with criminals, but with families holding receipts. You will hear people say it happened because of greed. That's too easy. Greed is constant, like gravity. The real cause is structure, the way debt sits on top of cash like a heavy person on thin ice. When the ice cracks, moralizing doesn't help. Now we arrive at the smoking gun, the document that seals fate. In this story, it's a confidential memo dated March 3, 2026, stamped Internal Liquidity Review. The memo admits a $620 billion collateral hole across multiple clearing members. That is the quiet scream. The meeting happens in a windowless room because truth hates sunlight. Regulators, bankers, and executives sit around a table like pallbearers. Someone says, "We can manage this with temporary funding." Someone else answers, "Temporary doesn't fix insolvency." The negotiations sound brutal when you translate them into plain language. "We'll lend, but only if you post better collateral." We don't have better collateral. Then we liquidate. It's a foreclosure dressed up as policy. A liquidation sale doesn't ask permission. It sells what can be sold, and it leaves behind what cannot. You see it in pension funds forced to rebalance into falling markets. You see it in funds gating withdrawals, claiming orderly processes. Orderly is just a pretty word for trapped. Then comes the climax, the default, the moment money literally runs out. It might be a major broker missing a settlement window by 45 minutes. It might be a household sector missing payments in waves, pushing charge-offs above 6%. The system doesn't die with a bang. It dies with a bounced check. When cash disappears, society changes temperature. The air gets colder, even in summer. People stop fixing things because repair costs money. Pride turns into quiet shame, and shame turns into anger. Hunger returns first in the least cinematic places. Not in dramatic famine lines, but in smaller meals, in skipped breakfasts, in parents lying to kids about dieting. The fridge becomes a balance sheet, and the balance turns negative. Humiliation follows because debt is a leash. People who felt sovereign feel owned by invoices. Cities cut services not because they want to, but because their tax receipts collapse. The streetlights dim and the darkness feels political. This is where the phrase becomes real, not poetic. Sovereignty is solvency. A nation with a broken ledger negotiates like a desperate borrower. It accepts terms it would have laughed at during the boom. It trades autonomy for funding. In this timeline, an emergency package arrives with conditions sharp as needles. Cut spending by $180 billion. Raise taxes by 2%. Freeze public hiring for 2 years. The public hears stability. The ledger hears we own you now. The social consequences widen like cracks in concrete. Crime rises in some places, but despair rises everywhere. Marriages break under the weight of bills. Birth rates fall because hope is expensive. The future gets postponed like a canceled order. And still the grind continues because debt works on calendars, not emotions. Each quarter reveals new write-downs, new layoffs, new bankruptcies. A famous brand files Chapter 11 with $73 billion in obligations, and pundits pretend it's isolated. Isolation is a fantasy in a connected ledger. Now, if you're listening closely, you'll hear the ghost of 1929 laughing softly. Back then, The crash wasn't the whole story. The depression was the story, the decade-long punishment for years of leveraged celebration. The bill came due, and it demanded payment in human life. In our 2026 echo, the question isn't whether markets can fall far. They can. The question is how long the balance sheet takes to heal once it breaks. Deleveraging is slow, like drying a flooded house with a teaspoon. The numbers get uglier when time stretches them. A 45% market drop can become 62% after 2 false recoveries. Unemployment can climb to 12%, then 16%, then hover. A recession can become a lost half-decade, quietly, without a single dramatic headline. People ask, why didn't anyone stop it? Because stopping it would have required pain earlier. It would have required saying no during the party. It would have required higher rates, lower valuations, smaller deficits, and less leverage. It would have required discipline, the rarest currency. In 1929, the generation that lived through it carried scars into old age. They saved cash under mattresses. They distrusted easy promises. They feared debt the way sailors fear storms. Trauma became policy in their personal lives. In this story, the aftermath for 2026 is written the same way. Young adults delay everything that looks like risk. Investors stop believing in permanent prosperity. Workers demand cash, not stock options. A culture that worshipped growth learns to worship stability. And the debt doesn't vanish when the headlines move on. It gets refinanced, restructured, rolled forward like a body being dragged. Governments issue long bonds, and future taxpayers become the collateral. The bill is paid by people who never attended the party. Here's the generational punchline, the one nobody wants to read. In this timeline, the final check for the emergency stabilization debt is written in 2044. That's 18 years after the temporary rescue. Let that number sink in. Childhood becomes middle age before the ledger closes. So what is the lesson if you strip away the drama? It's not that markets are evil. It's that leverage turns small errors into fatal wounds. It's that cash flow matters more than narratives. It's that a balance sheet never lies, even when people do. If you want to understand why 2026 looks like the Great Depression, stop watching the fireworks. Watch the funding markets. Watch the refinancing cliffs. Watch the quiet language in quarterly reports where liquidity starts appearing more often than growth. And if you're thinking, this is too dark, it can't happen, that thought is part of the pattern. The bubble always protects itself with disbelief. It tells you preparation is paranoia. It calls prudence cowardice. It wants you unarmed when the ledger turns. I'm not asking you to predict the exact day because nobody can. The spark is unknowable, and the timing is cruel. But the structure can be measured, and the incentives can be understood. That's what a financial detective does. He follows the money. Because history isn't decided by armies or politicians, not in the final accounting. It's decided by accountants, debt schedules, and resources that run out at the worst moment. Empires don't fall when they lose battles. They fall when they can't pay. So the next time you hear permanently high plateau in modern clothing, pause. Ask what sits beneath the optimism. Ask who holds the note. Ask what happens if rates stay high for 2 more years. Then read the ledger again. If this documentary changed how you see 2025 and the road into 2026, subscribe to the channel. The next episode breaks down what collapses first what survives longest, and what signals the cascade has started. Stay ahead of the people who only learn after the loss.